Thanks for tuning into this month's educational video. Today, Harry and I are going to be talking about some of the common mistakes we've seen clients make over the years to help prepare you to not make those same mistakes yourself. So Harry, what's one mistake that you've seen people make?
A mistake I definitely see people make is investing in things that they don't understand. And Warren Buffett, probably one of the greatest investors of all time, really points that out. He says, don't invest in anything that you don't understand. Mm-hmm. You know, another thing is David, that I notice that investors do is they just have a lack of patience. Do you notice that?
Yeah, absolutely. I mean, we hear pretty commonly, people talk to their friends or they read headlines and they see stocks up 20, 30% or whatever it may be. And they ask us like, hey, why isn't my portfolio up 20% this year? And the reason is because most of our clients aren't invested 100% in stock. So it is unrealistic to have that expectation or have that lack of patience to get those returns.
Yeah, that's a good point, David. And one of the things I always tell people when we're building our three balls is if you've got 50% of your portfolio in fixed income getting 2% and 50% of your portfolio in investments getting 10%, when you balance those two things off, your portfolio is going to average around 5%. So if you do want a greater rate of return than that, then you do have to add more equities, which obviously adds more volatility. So that's always a common goal that we're balancing for our clients, is getting a return that they're happy about, but also doing it within a volatility structure. And I think a lot of people can forget about that.
Yeah. And another thing that goes in with that is, and we've talked about it on many of our videos before, is trying to time the markets. And that sort of goes hand in hand with expectations as well. As people do get impatient, or they have a hunch that the market's gonna zig when it actually ends up zagging. But people try and time the markets to try and get those big returns, or try and avoid those big losses, which would ultimately improve their returns. But we've seen it time and time again. There's been numerous studies that timing the markets is exceptionally hard to do. Even institutional investors with huge budgets for research and all this vast experience and knowledge can't quite do it. So that's definitely a mistake that we've seen people make.
Yeah, that's a great point, David. Patience is so key. I tell clients quite often that it's almost like watching grass grow. It's boring to be a successful investor. But if you have the patience, if you allow the portfolio to go through the ups and downs that we know are going to happen, then you'll be a successful investor. So patience is just so critical. Another thing is just emotions. I mean, one of the biggest problems that I find that people have is we're all emotional. Mm-hmm. And so those fears or those excitements catch us. When the market's booming, we're all excited, we're all running, and we want more of it. And, mm-hmm. Study after study has shown that most people that invest at the peak of the market. Mm-hmm. We're completely the opposite. When markets are dropping and all of us are fearful, most people are selling. These are completely understandable from an emotional point of view, but from an investor's point of view are completely the wrong things to do. So one of the things, if you want to be a successful investor, is you have to manage your emotions.
Mm-hmm. Another thing that we see as financial planners is a lot of people actually spend more than what their portfolio can actually sustain. So when you're a retiree, you have a set amount of resources, a finite amount of resources in your portfolio to carry you through your retirement. And so part of the things that we do when we do our financial plans for clients is to try and set a budget and set expectations for their portfolio so that they only spend what their portfolio can actually sustain to take them to age 90 or 95 or whatever target age we're planning for. But and that's an area where institutional investors are at an advantage compared to individuals. I find is institutional investors, whether it's the CPP investment board or pension funds, they have a very defined goal in terms of how much income they want to pay out every year, whereas individuals may have that, but expenses come up. They want to pay for a kid's wedding, or a car goes that they need a major repair on, and they don't budget for these things. And that's one thing where people can run into mistakes too.
As we have mentioned, letting your emotions get the best of you when it comes to investing is probably the single greatest mistake that most investors make. This chart is one of our favorites to show clients as it helps visualize why it's so easy for folks to let their emotions get the best of them. This chart shows the annual calendar year return for the S&P 500 in blue and the annual max drawdown in red. This chart does an excellent job of depicting the volatility that you are required to endure as an investor if you are seeking 10% per year growth that the US equity market has delivered historically. From 1980 to 2020, the median annual return for US stocks has been 10.8%. Meanwhile, the median annual drawdown has been minus 13.2%. This means that while you can average around 10% per year by investing in stocks, you must be willing to live with a significant amount of volatility over the course of a year to get your 10% average return. The next time that you may be feeling anxious or worried about a market drawdown, this would be a useful chart to remind yourself of. Drawdowns of 13% in the stock markets are regular occurrences and par for the course. More significant drawdowns of 20, 30, or 40% happen much less frequently, but they too are also normal occurrences for equities. When these events happen, it is important to remind yourself that these drawdowns have happened before, they'll happen again, but if you remain committed and stay invested, the markets have always recovered and investors who can stay the course are always ultimately rewarded. Harry and I recognize that this level of volatility is the price of admission for any investors that want their portfolios to grow. However, most of our clients are not comfortable having all their money in stocks and dealing with this much volatility, or they are retired and cannot afford this level of volatility because they need to draw on income. These are important things to be cognizant of when you are analyzing your portfolio's average returns and perhaps comparing your portfolio to stock market indexes or any one individual stock. As mentioned before, another common mistake we see is that investors try their hand at timing the markets. There have been numerous studies over the years which analyze mutual fund and exchange-traded fund investment flows. These studies, such as the one done by Dalbar that you can see here, shows that the average investor's return barely outpaced inflation from 1998 to 2017. And it is not because the average investor had their money invested in poor investments. Dalbar's study found that the reason the average investor's return was not very good is because the fund flow data showed that when markets dropped, many investors sold their investments and moved to cash. The fund flow data also showed that many of these same investors then bought in again once the markets had already started to turn around, and whatever concern sparked the market sell-off in the first place had begun to subside or was no longer an issue.
David and I wanted to thank you for listening to this video. Remember, volatility is a normal part of the process to be a successful investor.
As always, if you guys have any questions, don't hesitate to give us a call.
Take care and be safe.